For more on this, we're joined by Tim Waterer in Sydney. He's Chief Market Analyst at KCM Trade. Welcome back, Tim. Now, there's a lot to unpack here. Let's start with equities. Both Japanese and South Korean stocks touched all-time highs, yet the tech growth is being overshadowed by intensifying tensions across the Gulf. Tell us more about that.
Nice to be with you again. Yes, that was the story today, wasn't it? A very sprightly start by markets in Japan and South Korea, particularly touching them all-time highs, as you mentioned. So very much driven by the AI boom there. So really for the first part of the session, investors were really ignoring events in the Middle East, but then reports about what's going on in terms of the competing blockades with the Iran and the US, seizures and interceptions of tankers, that sent crude prices higher, and that caught the attention of markets, and that dampened the party somewhat and saw the markets come off the highs, and partly due to profit, as you say. So it really was the market turning their attention mid-session away from the positive AI story and turning it more towards those crude oil prices, which were creeping higher during today's session by the tune of around about 1% for Brent and WTI. Now, Brent, that's already back above triple digits, so that's definitely catching the attention of traders, which brings stagflation fears once again to the fore, because we still don't know when this conflict will end. Is it weeks or is it months? So the economic fallout is still an unknown factor, and I think that's what dragged markets off their highs today.
Let's look at South Korea's economy. We had GDP grew 1.7% on high semiconductor demand. But how concerned are traders now that this AI boom could be peaking?
Very solid numbers there from South Korea's GDP, quite an upside beat there. And really it was the AI industry that was providing the backbone of the growth there, very much export-led. So is it peaking? Are investors worried? Well, the data says no. If we take SK Hynix, for example, and their growth outlook and sales outlook moving forward, they're saying their HBM4 chips, they're pretty much sold out for the next 3 years, and it's a bit of a struggle to keep up with demand. So as things stand right now, seems like we haven't peaked. Things can change, though, as we know. So we could get caught up if traders start to think they're a little bit overvalued at the moment. That's one issue, but I guess just looking at supply-demand story, I would say it hasn't peaked yet. If we're looking at South Korea's figures more broadly today, there was a bit of a softer domestic demand component there, so that's something to perhaps be a little worried about. But while the AI sector's booming, I think that can help insulate South Korea's economy from any headwinds which are emerging from the Middle East at the moment.
Now, gold and silver are also down. Where are investors looking for safety as this uncertainty continues?
That's right, gold and silver, they are succumbing to this combination of higher oil and in turn a higher US dollar. So that's putting some downward pressure on the precious metals at the moment. So where are investors looking as alternatives? Well, they really are turning to the USD right now in terms of currency markets as the favoured safe haven play. In terms of stock markets, we are seeing the tech names still performing well despite the events in the Middle East at the moment and concerns over how long the conflict could drag on for. So AI names still doing well, but we are seeing certainly let's call it a modest rotation into some of the more defensive sectors of the economy. So utilities, for example, and healthcare is another one as well. So moderate at the moment. We're seeing US stocks and a lot of Asian markets still riding high at the moment. But I think for gold and silver to return to their winning ways of earlier in 2026, we'll probably need to see a pullback in either the US dollar and or oil prices.
We'll leave it there for now. Tim Waterer in Sydney, thank you very much as always.